Welcome to another Maxwell Senior Moment coming to you from the worldwide headquarters in Roswell, Georgia. A few months ago, I did a little video on HECMs, home equity conversion mortgages. They're more fun to say HECMs, but they're also known as reverse mortgages. And I brought in an expert, Susan Pryor with Benchmark Mortgage, to talk a little bit about it. So thanks for joining us.
Thank you for having me.
So talk to me, what is a HECM?
So a reverse mortgage is a way for seniors to leverage their home equity into stress reduction. I say I'm in the stress reduction for seniors business. So basically, folks who are over 62 and a half and have a significant equity position in their home are in a position to either access funds from their home or potentially pay off a current mortgage. And as a result, they do not have to make a payment until they leave the home or they pass away. If it's spouses, it's until at least one of them has lived in the home for the last 6 months. And so it's kind of a way to get a really like a line of credit on your home so that when there are problems, you have access to funds. A lot of seniors are equity bound, so they or house poor, you might say. They own their home. Maybe they own a $500,000 home, but they own $50,000. But paying that $50,000 a month mortgage is super stressful when your Social Security is $2,200 a month. So it's all about that. This is the first generation of seniors who don't have pensions, and so it's all about trying to help them leverage what they do have, which is home equity.
Okay. I've given a speech before or a talk at a couple of senior centers, and when I've mentioned home equity conversion mortgages as an option, I say reverse mortgage, there's a visceral response.
Right.
Why the bad rap?
They do have a horrible reputation. And that really is that it's a government-based program. It was developed about 40 years ago for the intention of helping seniors age in place. It's a Federal Housing Authority program, but there were some unintended consequences of how they developed the program. Things happened that they didn't think would happen. So in 2015, they tore it all apart and put it back together. And now there's so many regulations, it's almost impossible to mess it up. For example, before I can order an appraisal or basically a client can agree to move forward, they have to go through third-party counseling. So I give them a list of 10 people that the computer generates that have nothing to do with me, and they have to call one of those people and do an hour consultation with one of those folks. They pay them a fee, and they make sure that they understand everything and that there's no confusion. And that protects me as well. So I appreciate that. So it's in my business, it's all about educating people. It's either the right thing for someone or it's not. And so that's cool. There's no sales component to a reverse mortgage. You either fit in the box and it's a good thing or it's not. And I work really hard to include the heirs if they're family members that are stressed out about it, because oftentimes it's the family members, not the seniors, who are stressed out about it. We like to get them on the call with a third-party person so they can ask all their questions without feeling like they're going to hurt my feelings or anything. But it's a really great tool for the right person.
In terms of when it's not right, can you give an example of why someone would not want to do it?
Sure. Well, the downsides, right? What is the downside of a reverse mortgage? It's the costs. We have to pay 2% of the appraised value into FHA's insurance bucket. So basically, if the house is worth $200,000, we have to pay $4,000 out of the home equity. Now, the senior doesn't write that check, but $4,000 out of the home equity that goes into that insurance bucket so that if there's a problem down the road and that person lives to be 150 years old, that a bucket of money is there to ensure that the taxpayers won't ever have to pay to cover reverse mortgages. And to this date, the taxpayers have never had to pay $1 to cover reverse mortgages. It's all been covered out of that insurance fee. But that does make the expenses expensive. So, but it's paid by the home. So basically, your home is donating. I mean, it could be $20,000. It could be like on a $500,000 house. It could be $20,000 in the funding fee and normal closing costs, because you usually have 3% closing costs on a normal house, but you have that plus you have the the funding fee. So that's the downside. The downside is that $20,000 ish or whatever gets set aside from the home equity to pay the expenses. So if you're going to move in a year, reverse is not a good idea. If you have a child who's going to need special care after you pass and is going to need the home as a place to live, you don't want to do a reverse mortgage. But people who, by the time you do sell other assets to pay the taxes to do what you might want to do with a reverse mortgage, that $20,000 is offset pretty quickly. So I always want you to know what the downsides are. Really, the only downside is the cost. And so the other thing people worry about is they think you're going to take their home. But really, a reverse is just a deferred payment mortgage. Right. So the balance of the mortgage is whatever you took out plus the closing costs. And then every month, if you don't make a payment, it's the interest only on the then rates for that month. So, if you accumulate another $800 in interest on you because you didn't pay a payment this month, the mortgage balance goes up by $800. They don't take your house. It's just $800 got added to the balance. So when you pass or when you sell your home, you just pay off whatever the balance is. It's set up to actually protect your home equity. So, for example, if you have a $200,000 house and you have a $100,000 reverse mortgage, your $200,000 house is going to go up in value 3-4% a year, something like that. And if you don't make a payment, then your $100,000 mortgage is going to go up to, maybe $108,000 in the first year, and then it's going to keep going. The idea is that your house value should go up way more than the balance should go up, even if you don't make a payment. But a senior could make a payment. So if they're super stressed out about leaving to their heirs, they can pay that interest-only payment every month, and it's just that you don't have to.
Okay. You answered one of my questions before I asked it about do they lose their home later on, but that's good to know. One of my favorite stories, I think it's your favorite story that you tell, is how a reverse mortgage helped a vet. You want to share that real quick?
Sure. So this is my favorite transaction of all time and the reason that I fell in love with reverse mortgages. So I do a lot of service with veterans and mortgages with veterans. And so when you help veterans, they bring you veteran problems. And so I had a veteran who was getting ready to lose his home. He's had a first mortgage and a second mortgage, and the second mortgage was foreclosing. He had a $400,000 house. He owed $100,000. And so he had $300,000 in equity. It was all he had in the world. His mortgage payment was $1,618, and his Social Security was $1,512. So obviously that math doesn't work. There was no one in his life who would talk to him anymore because he had borrowed from everybody, and everybody was super unhappy. His roof was falling in. He didn't have running water in his house. He had bonded his son out of jail and had an $18,000 bail bond on his house. His son had never done continuing education. It's a crazy town. So I had total fun with this. First thing we did was we raised a little money with my real estate agent friends. We caught up the first mortgage. We got a donated roof from a veterans company. Corning donated the shingles.
He was about 3 days from getting foreclosed
on his second mortgage. Yeah, he was going to lose everything. He was going to lose all of the equity in his home.
So that's what the GoFundMe was for, to pay that off.
The GoFundMe was to catch him up so that he could, so he wouldn't lose his house. And he wouldn't look at me when he first met me. He wouldn't. He would just look. He was afraid somebody was going to make him pay for the water we were drinking when I first met him. And he hadn't been to the doctors or because he couldn't afford his blood pressure medication copays. Like, it was bad. Groceries, gas, whole thing. So we gave him a little money to catch up. We rented the equipment to help fix the pipe so we could have running water because he was a machinist pipe guy. He could fix it, but he couldn't rent the equipment to dig up the ground so he could get to the pipe. We hired a bail bondsman. If you're here in the Metro Atlanta area and you need a female bounty hunter, I have your girl. So we hired a female bounty hunter to go pick up the 65-year-old son who had never done his community service. And of course, they released the bond, they released the son. Nobody really wants him in jail. We just needed our $18,000 bond relieved. We did a reverse mortgage. We paid off both mortgages. He got $25,000 at the closing. because his credit wasn't very good, I didn't want to worry that he was going to lose his house because he didn't pay his taxes. So we did a set aside for taxes and insurance so he doesn't have to make taxes and insurance payments till he's 96. He gets another $25,000 the second year in the transaction, a line of credit, and he's the happy as you could be. So I talk to him every 6 months or so, and he's a different human. He's working a full-time job now.
That's awesome. I love the fact that mortgages and bounty hunters can now be used in the same sentence.
There you go.
Never thought that would happen. Okay, so one of my favorite things that I think that a reverse mortgage could do is help someone with the financial planning aspect if they are downsizing. So let's play this scenario out. If someone has $1 million house or $500,000, it doesn't have to be $1 million, but they want to downsize and they are 62 and a half, they can sell their house, but instead of buying, let's say, a $500,000 house, they could put down roughly 40%, is that right? 40% on a $500,000 house, and then never have a payment.
They'd put down 60%. They would have that. Yeah, they would. So they put 60% down on a $500,000 house. They go to buy the next $500,000 house. They put 60% down, and then they would never have a payment for the rest of their lives.
So then they could take not only the profit that they had from the sale of the house, but that additional spread and invest it.
Yes.
So
yes.
It would be wise to talk to a financial planner. Yes.
Right. That would be a perfect angle for, like, if you're 62 and you really need to wait till 67 to take your Social Security. That would be a great strategy for doing that, which is to use that extra cushion to get you to 67, so you can get $4,000 a month in Social Security instead of $1,200 a month in Social Security. The spread between 62 and a half and 67 and 70 is crazy. So everyone needs to understand that when they're retiring. Where I see that the most, we call that a HECMA for purchase or reverse per purchase. Where I see that the most is everybody wants to retire and not have a mortgage payment, right? So they still owe $100,000 on that $500,000 house, and so, well, I could go buy another house. If I could just find that house for $350,000, that would be my retirement home. Problem is, you want to retire with the grandkids, or you want to retire in the mountains, or you want to retire at the beach. So why did you work your whole life to make such a massive sacrifice at this point? If another $150,000 would get you next to the grandkids without an hour commute, or would get you to that mountain house without an hour commute, why not take that same $350,000 that you were going to put down, do a reverse for the remainder, and then you pay it if you want, or you don't pay it if you make payments if you want, or you don't if you want, but you still accomplish the same goal, which is living near the grandkids, not having more than $350,000 invested, and you don't have any mortgage payments. So it's just a strategy to help people live where they want to live. It's not for everybody, but if we don't all need to be so stressed out when we retire so that we can have a paid off house. If you have more than $2 million in assets, there's no reason to talk about a reverse mortgage. But if you have a lot less than that, but you have home equity, then it just makes sense to at least consider how a reverse would improve the quality of your retirement.
Sounds like a plan. So obviously, talk to your financial planner. And if someone wanted to talk to you about reverse mortgages, how would they reach you?
Go to southernmortgagespecialists.com.
There you go.
southernmortgagespecialists.com.
All right. Susan Pryor, thank you so much for joining us. Did I forget anything? Is there a question I should have asked?
I am absolutely certain there was, but I don't know what it is. So.
All right. Until next time, thanks for watching, and we'll see you soon.